If you think you know where rates are headed, you're lying to yourself. In today's episode, I talked to my friend Dave Larock, and we discuss interest rates, where they're headed. We talk about the housing market and the chaos machine and the corruption machine. Hint, it's something to do with politics and how it's affecting the mortgage market in Canada. This is a fantastic conversation I have with Dave. As always, I love my conversations with him. I think you're going to find it valuable. We also dive into talking a little bit about cash damming as well as the M1 product. And hint, it's probably going to be controversial for some people, but it's definitely worth having a listen to what his perspective is on this. Hey, I'm Scott Beckford. This is the I Love Mortgage Brokering podcast, and each week we bring you episodes to help you, inspire you, and inform you on how to grow your mortgage business. And Dave Larock's episodes are always a hit. Before we jump into that, I want to give a shout out to our sponsor, Omwell. Omwell is an amazing tool for Canadian brokers. It allows them to create these reports that are sent on a monthly basis. They go in by email and they basically show your home equity, your buying power, your mortgage options, and they create tons of conversations. They get 60 to 80% open rates, and brokers are using them to create deals and find deals in their database. Check them out at omwell.ca/Scott and check out this conversation with Dave. Hey, Dave, welcome back to the show.
Hi, Scott. Good to see you.
You know, I always think of you, you're like my armchair analyst or armchair economist. I know you're not technically an economist, but you do have a lot of insights and you're able to talk about it in a way that is relatable for brokers and clients especially. So thanks for coming on and chat with me.
Happy to be here.
Lots of big things happening right now. You can see with the tariffs and stuff and interest rates. And so I guess maybe give me high level what you're seeing and like what you're, the kind of conversation with your clients, and then we'll get into the weeds of like specifics in a minute or two.
Sure. Well, really what we have right now more than anything is uncertainty. And that term, interestingly, the Bank of Canada, when it met last week, published its quarterly monetary policy report. And they used the word uncertainty 22 times in the report. And then for good measure, at his opening press conference, the Bank of Canada Governor Chair Tiff Macklem added the term uncertainty 7 more times. So they used it a total of 29 times.
They want to make sure that they're uncertain.
Yeah, exactly. And that affects everything. That affects the bond market. That affects what the Bank of Canada does with its policy rate. It affects whether or not people want to buy houses, whether they go fixed or variable. It's pervasive in everything. And of course, the vast majority of this uncertainty is emanating from the US and from specifically President Trump. And
right.
Scott, I'm going to be very blunt. And what I'm going to say is not politically correct, but it is my honest assessment of what's happening. Trump is a con man. He's totally corrupt. And he's created a chaos machine over here to distract people from the corruption machine that he's running over here.
Right.
His sons started a crypto company. The Saudis last week agreed to buy a 49% share in that crypto company for $500 million. Now,
right.
That crypto company probably isn't worth more than the stationery that they bought.
Well, it's worth $500 million that was just put into it.
Right.
Maybe.
So they paid $500 million to be a minority shareholder in the company. And the company is effectively worthless. So why would somebody do that? What is the other side of that coin? Clearly, the Saudis aren't dumb. That's a lot of money. Why have they agreed to buy a company that makes no money for $500 million and to accept a minority share? The only explanation is that there's another deal that we don't know about, and that's called corruption. When you're a politician selling favors and access, you're corrupt. And that is just last week. This stuff with Trump goes on and on. So the chaos machine keeps everybody distracted so that the corruption machine can run in the background. And that will be the case until either his term is up and he leaves office. I don't think a lot of us are confident that'll happen. Or until he is no longer president some other way. And I'm hoping for impeachment myself. But
I guess that's it's going to be interesting. Okay, so all of this is leading to a ton of uncertainty. So I want to bring it back to Canadians and how it's affecting our housing market. So what are you seeing the trickle down effect into, let's say, the housing market and then into interest rates from this chaos machine and corruption machine that we see? That it's like we're living. One time I heard, I don't know if you said it to someone. It's like Canada is living in an apartment above a meth lab.
Yeah,
and we're like, what's going on down there?
It was Robin Williams. Yeah, he said Canada is a nice 2-bedroom apartment living over top of a crack house, I think was his quote.
It kind of feels like a little bit like that right now. So okay, what I guess what is your thoughts on how it's going to affect real estate in the short and long term, and then same with interest rates?
Well, I mean, buying real estate is a massive decision. It's for most people the biggest investment they'll ever make. So you don't want to do that in a time of uncertainty. You'll be hesitant to do that in a
Mm-hmm.
time of uncertainty. And that is a strong headwind for all of our real estate markets. Interestingly, other than Toronto and Vancouver, the real estate markets everywhere else are doing pretty well. But Toronto and Vancouver, I mean, they had overbuilt. We've had overbuilding with condos, and our property prices have gotten away from average incomes. So the price correction that is happening is good long term. They say the best cure for high prices is high prices. If people can't afford to pay high prices, then they come down.
Right.
But certainly for now, with people really unsure about what the future looks like, they're less inclined to buy. Kuzma is up for negotiation this summer. And I think a lot of people, businesses and end users, consumers are waiting to see how that nets out. A lot of the threats from Trump now are, I think, posturing in the lead up to those negotiations. Interestingly, he said that was the worst trade deal ever signed. Somebody should whisper in his ear that, by the way, he was the one who signed that deal back when it was instituted, and it was the best deal in history when he signed it.
It's tremendous.
But
Everybody agrees.
But that was then and this was now. I wish I had a Trump impression, or I'd give it to you. So
my son can do a pretty good Trump impersonation, actually. It kills me when he starts going off. I'm like, oh my God, I'm going to die.
There are some good ones out there. We should practice. Anyway, so bond market right now, lots of uncertainty. But the challenge we've got with Government of Canada bonds is we're still very tied to what U.S. Treasury yields do. They have a gravitational pull globally. And because our economies are still quite intertwined, if U.S. Treasury yields go up, they pull Government of Canada bond yields with them. And interestingly, while everybody's focused on whether the Fed will cut, the bond market doesn't think the Fed needs to cut or should cut. And it's counterproductive because if the U.S. Federal Reserve cuts its policy rate, and the result is that bond market investors push up U.S. Treasury yields in anticipation of more inflation to come, that's counterproductive because more of the U.S. economy borrows at long-term U.S. Treasury rates than at the Fed short-term rate. And so actually you're better off without those cuts if they lead to higher bond yields. And really what bond market investors are concerned about is all of this profligate spending by the U.S. federal government led by President Trump. So the reality is there's concern about the U.S. deficit, U.S. inflation, U.S. debt levels. No sign of any change in behavior ahead. And ultimately, we're getting pulled along by that. The gravitational pull of U.S. Treasuries is powerful on Government of Canada bond yields. Domestically, the Bank of Canada is uncertainty as it is. The bets that we have seen, there were some bets about maybe the next BOC move will be a rate increase. And the swap market was pricing in a BOC increase at the end of this year. I think that's lunacy. I think when the Bank of Canada is saying, we don't think we should cut now, but we're going to use the term uncertainty 29 times when we communicate to the public about our assessment of where we are. That is a very dovish tilt. And I've been saying for some time, I think more cuts are in store. And certainly there was nothing last week in what the BOC said that caused me to change that view.
In terms of if we dumb this right down, so tell me like I'm 10. So are you expecting that this is going to make rates go down for us or up? Like what is that going to do?
I think all of the uncertainty and the headwinds for the U.S. economy will mean that the variable rates will likely go down because I expect the Bank of Canada to cut again. And again, that is
okay. What about on the fixed side? What do you think is going to happen there?
The fixed rates are priced off of Government of Canada bond yields. Government of Canada bond yields I think, will have a hard time going much lower because they will be pulled along by U.S. Treasury yields, which are going up.
Right. Okay. So that leads my next question then. So given what's happening in all this uncertainty, said 22 times, maybe 29 if we include the other 7. What, like when you're talking to a client and they're trying to decide, what does that conversation look like? So if I'm your client and I'm trying to decide, and let's assume I'm a qualified client and I've got some equity, so it's not like I have some. What does that conversation look like, as opposed to a first time buyer who's putting in their first 5% down or something?
Yeah, I think first-time buyers typically should opt for fixed rates just to have the stability of a fixed payment because they're taking on the cost of homeownership for the first time. So my advice, and again, all of the advice is personalized. The reality is, if somebody says to me, which do you think is going to be cheaper over the next 5 years? I think variable rates are probably going to save a bit of money. But I don't have a lot of confidence in that view because it's very difficult to predict what the future will look like. I think anybody offering a confident view of where rates are headed right now shouldn't be believed by rule. because I mean everything seems to swing based on Trump's whim, and I'm not sure he knows when he wakes up in the morning what he's going to do an hour later. So how in the world can the rest of us have
Yeah, how can you predict?
Yeah.
Right.
But, gun to my head, I think variable rates will probably save a bit of money. But the reality is, even people who could take variable rate risk right now are seeing a lot of instability in the world. And at a time like this, opting for stability is never a bad option. So it really comes down to what's going to help you sleep at night. So,
Yeah.
if the question is which option will save you money, I think it's variable. But in uncertain times, the appeal of stability increases, and most of the people that I'm working with today are opting for fixed rates for that reason.
I was going to ask. That was my next question. So if you look at a percentage of your clients, so let's use not the first time buyer profile, but the qualified borrower. What percentage of them are you thinking going into fixed right now with you?
I would say,
and I know you always say you can't see around corners, and your job is to advise. And so I'm not asking you to advise. I'm just curious which side the coin's landing on.
Yeah. Well, I mean, the reality is, people ask me which I think will save money, and I say variable, and most of them are choosing fixed. So there's a short answer, Scott. I would say probably 75% of the borrowers I work with are opting for fixed, and 25% are opting for variable. And the ones who opt for variable aren't doing it because they think, the whole idea last year, remember we talked about this, they said,
because I remember last year it was a higher percent of variable last year. And I'm in a variable too. So there was like 60% variable, I think you told me, if I recall correctly.
Yeah, people had this play in mind. They were going to go variable. They preferred fixed, but they were going to go variable on the bet that fixed rates were going to fall. So they were going to start variable and they were going to convert to fixed because fixed rates were going to go down to 3.5 or lower. And I said back then to anybody in my blog and on, I think you and I talked about it. I said, I think that's a bad strategy. Go variable if you're prepared to stick with variable, but don't go variable if you think you're going to time the market, because ultimately that's a risky bet. And sure enough, fixed rates didn't go to 3.5 or lower. And there are people now sitting in variable thinking fixed rates are going to fall, still preferring fixed as their really the choice they're more comfortable with. And they're probably still stuck in variable because fixed rates haven't gone down. In fact, they might move up in the next little while. And if that happens, then some of those borrowers will convert to fixed rates at much higher rates than they could have got. And that was the danger.
Right. Yeah. That makes sense. Okay. So then what do you think? What about inflation? What do you think how this is going to affect inflation? So we talked housing market, certainly Toronto and Vancouver seem to be getting hurt the most. And what do you think is going to do with inflation in the near term?
Well, inflation, it's interesting. What is inflation? If you look at the
how have they changed how they measure it? Because I know that every time I talk, I feel like there's like, hey, this is what inflation is. Like the definition keeps changing. And then can we even compare to previous periods if we use a different definition of what we call it, the inflation?
Yeah. Well, so here's the thing with inflation. Right now, inflation, it went up last month, but for a very explainable reason. Basically, if you remember last Christmas, Prime Minister Trudeau offered everybody a GST holiday. And at the time, on a bunch of stuff. And at the time, that lowered prices. And the CPI only looks back 12 months. So last month, the tax discount that had been temporarily superimposed over prices a year ago rolled out of the CPI data set. Once that's called a base effect. Once that discount is 13 months old, it no longer gets counted. And now it looks like prices went up. So the inflation rate goes from 2.2 to 2.4, and everyone says inflation goes up. Well, the reality is inflation didn't really go up. All that happened is the tax holiday, which many people thought was ill-advised anyway a year ago, rolled out of the 12-month look back, and that caused inflation to effectively normalize. So over the short term, there's a bit of upward pressure on inflation, but the Bank of Canada doesn't just look at the consumer price index. They assess inflation overall. And interestingly, if you want to look at where inflation's headed, I think it's going to fall in 2026 pretty steadily. And the reason why is shelter prices. Right now, if you look at the CPI, it says average rents are going up by 5% year over year.
Mm-hmm.
And any real estate agent would tell you that's nuts. Real estate,
no, not in my market.
Yeah,
they're building so many built rentals. They're not even filling them all. And so it's a competition to get tenants.
There's incentives now, free couple of months rent, free cable, free Wi-Fi, free everything. And rents are falling. Yeah. But interestingly, the way that rent costs are calculated by StatsCan, they take all the leases outstanding and average them. So if current leases are falling, rent rates are falling, that doesn't impact the overall group of total leases until there's enough of those discounted leases coming in that they start having more weight on the overall grouping.
Right.
So we're in a situation right now where rents have fallen for long enough that we know that they are increasing as a proportion of the overall pool of outstanding leases. But even though that's baking itself in slowly, it's not moving the data yet. A lot of the increases that are now that have been there for some time are still pushing rents higher. That's why the stats say they're going up by an average of 5%. But even though at the margin, today's rents are falling. So when people say inflation, where's it headed? You have to say, well, some of these long-term factors, rents are one, mortgage rates are another. Average mortgage rates aren't going to reflect the fact they've fallen from their peak down from 6 down to 4 until more and more of these mortgages renew. And right now, people are renewing COVID mortgages they got in 2021 at 1.79, and they're taking new mortgage rates at 4%. Well, in another year or two, they're going to be coming out of 6% mortgages and going down to 4% mortgages. So if rates stay anywhere close to where they are now, in the future, we've got a big drop in mortgage interest costs coming. And the weighting of mortgage interest was increased last year, and shelter costs are a third of the overall CPI. So we're talking about the biggest single shelter costs are the largest component of CPI. The biggest components within shelter costs are rent and mortgage interest costs. And we know that those numbers are falling, but it's taking time for them to actually move the overall data. So when you say where's inflation headed, these very heavily weighted components already have disinflation built in, but it isn't yet coming through in the numbers. So I think overall, aside from the fact the economy is slowing, businesses are cautious, consumers are more cautious, spending is down, all of that other stuff. When you add to that the fact that shelter costs, unless rents suddenly start rising again or rates suddenly start materially rising again.
I can't see rents going up in the short term. There doesn't seem to be the demand for the supply at the moment, at least not when I'm speaking from my market. So, yeah. And I think some of these like this, CMHC programs that do purpose-built rentals with, like, those are creating a lot more inventory because everybody thinks they're going to make. It's sort of like there was the gold rush of Airbnb. Everybody bought a condo for an Airbnb. Well, once everybody did it, it was no longer as good of an idea. And if they change the rules around it, and I feel like that's what's happening with these rentals. So it's going to definitely affect rentals, I think, long term. I got a question for you. I've never asked you before, and I've just thought of it as we were talking. So there's a lot of just brokers out now that do a lot of talk about cash damming, and like, what are your thoughts on cash damming? How you understand it? I mean, you're one of the smartest mortgage brokers I know in real life, like that actually can talk this stuff. But what is your understanding of it? And I'm curious what your thoughts are.
Okay, so you're talking about making your mortgage interest tax deductible and borrowing to invest?
Yeah, well, there's a few different strategies. There's some people borrow to invest. I think that's less. It's more like what they're doing is, let's say they have a rental. You take the rental income to use to pay down your principal mortgage and pay interest only on your rental, so that effectively converting your debt on your primary residence into tax deductible debt to pay your rental property. So your rental property stays high interest, keeps the interest. And does that make sense?
Yeah.
Kind of like, but so effectively, that's one of the big things they like that is very popular. But I'm curious what your thoughts are on that. And then the other one is just at the effect of like, hey, you've got a bank, you set up a mortgage that's also attached to your bank account, and any extra money goes against your balance. That like the M1 product, for example. So that would be another strategy that people are talking about. I'm curious what your thoughts are. As a guy who understands math and also understands, like, even when you're talking about CPI, you understand it's not just the number. It's like, how do they get to that number? So what are your thoughts?
Okay, so two questions there. The first one about making your interest tax deductible through cash damming and basically converting the interest cost on your principal residence, which is not tax deductible, into mortgage interest on your rental property, which is tax deductible, right? That's ultimately, okay. So it's all fruit of the same tree. At some point, you can either pay off principal or you can use leverage and keep your properties leveraged and invest that money instead.
Right.
And if you are deciding not to pay off mortgage principal and to keep your leverage the same, because every dollar of principal you pay off in your principal residence, if you then transfer that to rental property debt, you still have a dollar of debt. So let's say you have $100,000 that is tax deductible on a rental property.
Yeah.
The trick there, if you own a principal residence in a rental property, is that you are using you're trying to convert the principal residence mortgage interest debt, which is not tax deductible, into tax deductible mortgage interest debt on the rental property. That is a net gain because your tax rate is lower. But at the end of the day, if you choose not to pay off mortgage principal or you reborrow against a property to invest, you've got to be confident that the rate of return you can earn with that invested money is going to beat the cost of interest. Now, if you're trying to beat the cost of interest on a principal residence that isn't tax deductible, then and your mortgage rate is 4%, you have to earn an after-tax return on your investment of greater than 4%.
Yeah.
So if you want to buy government of Canada bonds and you got to pay tax based on your interest income received on those bonds, it doesn't math. You're not going to make more than 4%. So you have to take on more risk if you want to get a higher yield. That means that you end up ahead because you have to make something on the spread, right? You got to make something on the investment that's higher than the cost of the mortgage, an after tax yield on the investment that's above this 4% threshold. In the current market, to achieve an after tax return of better than 4%, you got to take on some risk. So reality is it a good idea to do that, to take on risk? Well, I'm a conservative guy. I like the bird in the hand. When you pay off your mortgage, you know you've paid off that mortgage. You're never going to pay interest on that debt again. If you choose not to pay off the mortgage and to divert those funds to investments by reborrowing them on an investment property, which makes the interest tax deductible, well, then you're deducting the interest. So now you don't have to beat a return of 4% because you can then deduct the interest cost against your income. Maybe the after tax return you have to beat is 2.5%. That's easier to do. You don't have to take on as much risk to beat that.
Right.
So it improves the trade-off. But fundamentally, it still means that when you have a choice of how to spend your dollar or invest your dollar, you can invest it by reducing your mortgage, and you can invest it by putting that money in the market and trying to beat the return or earn a return that's higher than the cost of the mortgage debt. If you pay off the mortgage, you have 100% certainty that you've saved the cost of the interest. If you put the money in the market, you might win, you might lose. It's a riskier strategy.
So all this to say, then it sounds like it's not something that you typically do. It's not like, it doesn't sound like you are, as a conservative guy, most of your clients are just looking, you help them pay the least interest over how long they have mortgages, whether that's a combination of fixed and variable, and you're strategizing. Is that what you typically are finding with most of your clients? Is that what they come to you for advice on, product selection? I'm just curious.
So I think it is a strategy that can work for folks, but I think it's people who have a lot of investment capital. They're trying to minimize tax. They're sophisticated in that sense. They've got, it is when Fraser Smith wrote the book, The Smith Maneuver, which I did a part 1 and part 2 blog post on that has had a lot of readership over the years. In fact, I promoted it this week in my blog post because I have a section where I go back to past posts that I think are worth another look. And I provide a summary of how that works. And Fraser Smith wrote his book at a time when you could earn a 10% yield in the market and your mortgage rate was 5%. And back then, earning a 10% yield, believe it or not, wasn't crazy risky. So it was a heck of a strategy. And back then, I think it made a lot of sense for a lot of borrowers. But we're in riskier times. You have to stretch more to get yield. You have to take on more risk, and markets are more volatile. That makes me instinctively think that only the most sophisticated borrowers should be looking at leveraging to invest. We can do more mortgage business if we promote the strategy, but is it good for the average borrower? I am conservative, and I'm not convinced that that's a risk most people should take.
Okay, that's fair. I was just curious about your thoughts on that. So inflation, you think is
Can I talk? Can I talk about M1 for one sec?
Sure.
Okay. I'm sorry, Manulife. I'm not going to win any friends here today. You can have someone on Manulife come on your podcast and tell me why I'm wrong. But here's my take on the Manulife One, which I've had personally, by the way. Mm-hmm. Manulife promotes that product as saying it's going to change your life because you're going to pay off your mortgage so much faster. And in the examples they use, there are dramatic savings that come with their product. And here's how it works. You have a mortgage and a line of credit. And because it's a product that includes a checking account, if you keep money in the checking account, any balance in the checking account is credited against the amount that you owe on the line of credit. And that saves a pile of interest. And that's 100% correct. That is true. But a couple important points. It doesn't go towards the mortgage interest. If you have $10,000 in your checking account with Manulife One, and you owe nothing on the line of credit, you don't save anything on the cost of the mortgage portion. It's only on the line of credit portion. So here's the smoke and mirrors in the marketing promo. And quite frankly, shame on them because it's dishonest. I don't like the way they promote the product. Here's what they say. You get a Manulife One. If you have $100,000 in a checking account and you owe $100,000 on the line of credit portion of your Manulife One, you're not going to pay any interest. And then they calculate how much that saves you, and it's a big number. And everybody goes, wow, this is a great product. It's so much better than the other ones. I should take it. Well, I asked the Manulife friends one question. If I have $100,000 in my checking account and I owe $100,000 on my line of credit, why don't I just pay off the line of credit? If I have a Scotia step mortgage or an RBC home plan or a TD flex line, why would I keep $100,000 in a checking account and owe $100,000 on a line of credit? I would just use one to pay the other. And then my savings is exactly the same as if I had a Manulife One product. So yes, if you want to keep a huge amount of money in a checking account and you're going to owe money on a line of credit at the same time, which makes no sense and no rational person would do, then yes, that is a good product for you and you'll save a lot of money. But it's not magic.
Right. Okay. Yeah, you're probably not going to make any friends. I know that we did a lot of business with Manulife last year. I think they got some unique things to that product that I think it's still going to be a good product.
I'm not knocking Manulife overall, but I think that marketing is misleading, and I've just explained why. And if someone from Manulife disagrees,
people need to do the math. They need to do the math and understand it, and then they can make a decision on it. So that's really helpful. Sure. And I love, Dave, whenever we talk, you just tell me what you think. I don't need you. I like that. This is so I think that's really good. Okay, so
and by the way, last thing, Scott, on that. If anything I've said there is wrong, they're welcome to come on and send me the link, and I'll be sure to watch it
and listen to it. Research. Okay, so who do you read? So I know that I read your stuff, but what do you read in order to stay informed? So if you were to pick 2 or 3 things that anybody listening, I recommend you go follow Dave's blog because you do make it accessible for brokers. And frankly, we're not all that. You don't need to have I say all you need is a grade 9 education and basic math skills, and you can be a mortgage broker. And so if your blog is great, but what else do you like to read outside in order to kind of keep you informed?
I subscribe to a morning email called morningbrew.com, which gives a detailed summary of the markets, what's happening in politics, basically the news of the day. It's like an online newspaper, morningbrew.com. That's a good one. I like a guy out of the US called John Malden. He's not an economist, but he writes a lot about the U.S. economy. He's an investment guy from background. He's been around forever. He follows a lot of really interesting people and quotes other folks. And I like those guys, the aggregators who kind of distill what a lot of other people are saying. I find that saves me a lot of time. And also, if the source itself is credible, then they do a pretty good job filtering the sound from the noise. I subscribe to David Rosenberg. He's an economist. It's about $1,500 a year to get a Monday email, a daily email Monday to Friday, with about a 10 or 15 page report on everything affecting stocks, interest rates, what's happening around the world. I've read his stuff for quite a while. I subscribe to The Economist. And the cool thing about The Economist is you can choose what categories you want to follow. There's like 20 of them. I get the U.S. news every day. I get the global news and I get the economic news. And that's a lot of emails in my inbox. Sometimes they pile up.
How much time would you say you dedicate in a week to staying sharp on what's going on?
On average, at least an hour a day, sometimes 2. And then usually when I'm writing my post on the weekend, I'll spend another hour or 2 reading stuff, a lot of times catching up. I get a weekly email from Edward Jones. I follow CIBC. Has economics reports. They put it through A.B. Schenfeld. Benjamin Tall sometimes writes them. We all love him. Bank of Montreal has some good reports. TD does. The banks all do summaries of any major release. So when we get the employment report, TD, BMO, all of them will do kind of a one-pager. So if there's something big, especially if it's wonky or looks different, I'll try to read as many opinions as I can. I'm a subscriber at the Globe and Mail as well. You get access to more articles if you do that. It's not a lot of money. You can expense it. And I think the Globe is an excellent source of news. I'm kind of a junkie for this stuff. I mean, if I
Yeah, I can tell. So here's what I tell you. If you're listening, you're oh my God, just follow Dave's blog. He's going to synthesize it for you. And you don't have to listen to all that. Yeah, as soon as you start, I'm like, okay, the Morning Brew I'd heard of, the rest of them all, and the Globe and Mail, of course, but an Economist. So, but
I would say Morning Brew and Globe and Mail, those would be the first, that'd be where you start. And then if you're interested in it and it's fun for you, I mean, you got to read something while you drink your coffee every morning. So it becomes a habit. And then
it keeps you sharp, and you can have these intelligent conversations with your clients as well, and referral partners about what's going on. And I know for you, that's been a big part of how you built your personal brand and your business is just around being very up to date, up on this stuff and understanding it and communicating. It's one thing to understand it, but if I don't understand what you're saying to me, then it's like blah. It's like Charlie Brown's teacher, blah 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 blah. But you're able to communicate it in a way that people get. So I appreciate that, man. Is there anything I didn't ask you about that you think, Pete, that you're thinking about, or that is like on your mind right now when it comes to the economy or Trump or all the stuff that's going on, the chaos and the corruption? I think is what you called it.
Yeah,
machines.
The chaos machine that hides the corruption machine. Yeah, no, I would just say, Scott, we're living in really volatile times. It's hard right now. We got the darkness of winter. We're not getting a lot of sunlight. It's cold outside. I go for a run most days. I get outside now, feel the sun on the face, take the dog for a walk. I would just tell people, don't let this stuff get you down. Feel the sun on your face, take a deep breath, go kiss your loved ones. It's all going to be okay.
Life is short. Yeah, exactly. And this will pass. And yeah, that's really good. Well, I really appreciate Dave. You're always coming on and being open and chatting with me. It's awesome connecting. Check out Dave's blog if you haven't already. Thanks, brother. I really appreciate it.
Thanks, Scott.
Hey, thanks for listening. And hopefully you got some ideas or inspiration, at least from my conversation with Dave. I'd asked him some questions on this episode that I've never asked before. I asked him about what he thought about cash damming. I asked what he thought about the M1 product. And I also asked him about who he reads, because he's obviously very well read. And so these are some different perspectives I thought I would get from him. And whether you agree or disagree, the whole idea with this podcast is to provide you with some perspectives. And then you can go back more informed and make the decisions that are best for you, your business, and your clients. As I always say, there's no problem in your mortgage business that isn't already solved. Your problem is who's got the answer. This podcast is designed to provide some of those answers. Thanks for listening, and I will see you on the next episode.